Yeah, definitely. Various sovereign entities in the Middle East have in the past mostly focused on Western economies. And most of the asset allocation in the past has been to the West, Europe, UK and the US. But what has changed since the last 4 years is, given the depressed environment in these Western economies and at the same time the strong GDP growth that is still sustained in emerging economies like India and China, sovereign entities have started paying attention now to geographies like India. And to some degree, of course, the credit goes to Indian managers who have now built a history of at least a decade of private equity investments. But at the same time, India is also a beneficiary of how the West has gone down. So, from a risk-reward perspective, I must mention that the returns that were promised from Indian fund managers have in some cases not been delivered. So there is a disappointment that exists amongst LPs in general. But given the fact that these returns are still better than what others have delivered, you still shine amongst the lot. Like in most other emerging economies, and India is no exception, there are several reasons, particularly related to corporate governance, where LPs do worry. And these become specifically important in the cases where you have managers running first-time funds. We worry as to how the money is going to be deployed, and particularly about the fact that there should not be any leakage from the fund when such fund managers were to say tie up with the promoters who are selling their stakes into such companies. Now, these can be overcome in the cases where the funds have demonstrable track record. So in cases where the managers who are raising the third or fourth fund, this situation is overcome because LPs are familiar with the people who are running it. But in the case of first-time funds, we are skeptical about the background. And besides the usual things that you hear about track record, IRRs, etc., corporate governance is another important issue because of which this problem or there's a skepticism amongst LPs. Sovereign wealth funds are definitely interested in private equity in the two directions. The first direction is, of course, private equity funds, which are operating in India, but at the same time, sovereign wealth funds also have started looking at direct investments, and they're investing directly into Indian corporates. So there has been now in the past 3-4 years an increased amount of allocation from practically all of the sovereign wealth funds. Now, the South Asian sovereign wealth funds have been around for almost 10 years. And the Middle East sovereign wealth funds have started doing that since the recent economic crisis in 2008. So they've started actively investing both in direct investments as well as private equity funds. I can definitely share with you that some of these funds have a much deeper mandate that we may realize actually. For example, they are entering into majority stakes in large resource plays in countries which are practically unknown to the rest of the world for investing. So they're moving into various countries in Africa, taking majority stakes in companies to actually support their manufacturing industry. So they're doing that to build an expertise, to build something that they can take back to their country. Now, when it comes to India surely has serious constraints on raw materials going out of the country. And that's the reason that you don't see some of these entities entering into same sort of strength and in India, because there will be restrictions for what they can take out. And these entities don't necessarily look for capital to be going out. They're looking for actually raw materials and resources for their enterprises that are being operated in countries like China. Yeah, sure. I would like to give you a background as to why the Western LPs have been more open to India than the Middle East. One, a lot of Western LPs actually have Indians working for them, and these are some very smart people. So there's this comfort of them knowing the country because they're born and brought up here. Plus, Western LPs have found out, because of the severe competition that exists in their own geographies, that in order to increase their returns, they need to look at emerging economies. And thanks to Goldman Sachs' BRICS report, India, China, Brazil, Russia rank ahead of most other economies. So that's why India got a favor and got into the good books of most of these Western LPs, so to speak. When it comes to Middle East investors, they've, for various reasons, have always focused most of their assets in Europe and US, because a lot of Middle East investors or funds are actually managing funds on behalf of the government, and that money really belongs to the people of the country. So they cannot be as aggressive as others when they're actually deploying these funds. Two, given that it's fairly recently that they started looking at India and China, and I mentioned to you why they started doing that, but of course it's because of the interesting demographics of India and China, the growth rates that exist in the country, but at the same time because of what's happening in the West. So I think a couple of years from now, you'll find that it will be much easier for the GPs in India to be able to attract the investors from Middle East. In terms of the life cycle of what an LP goes through when it starts investing into a new geography, it typically first wants to go with an established brand name where you can trust that there will be certain standards of corporate governance maintained, and they know that the money will not be misused. So they would like to first go with that. So it could be a large brand name in any country, and each country has some large brand names who have attracted attention from investors all across. And when such brand names set up their own private equity firms, they're able to raise funds easily, and that's happened with Middle East as well. I mean, Middle East investors have committed capital to such established brand names. So that's the stage, I think, what Middle East investors are currently in, and that's what people in the past have gone through from the Western economies when they came as investors to India. A few years down the line, when through these first funds, which are established brand names, when the Middle East investors have more experience in the geography, they learn the dynamics, they build relationship and trust, then moving forward it will become much easier for them to start then focusing on fundamental things like how good is the specific manager. So once they've crossed that hurdle, then they'll be able to take the risk on individuals. Currently, that's not the position. Currently, they're still averse. We do not want to risk money with first-time fund managers. The other thing that happens is that there are fund of funds in the Western economies who could be looking at late-stage VC or early-stage growth capital, which falls in the ticket sizes that typical Indian transactions are happening. So typical Indian transactions are less than $50 million. Now in the Western economies, the fund of funds, etc., are looking at funds who are doing something like this.
True.
Whereas from the Middle East point of view, the sovereign entities are looking for ticket sizes which are much bigger. Now, while they want much bigger ticket sizes, at the same time, they do not want more than, say, 10 or 20% exposure to the whole fund.
True.
And that's where the dilemma comes in. So if you want to deploy $100 million and you can only be at 10% of the fund, that means a capital of $1 billion. I don't think Indian private equity industry has reached that point, and that's another barrier because of which sovereign wealth funds are not able to support Indian funds yet, especially from the Middle East. But I think as the industry progresses, currently the Indian industry is still focusing on private equity plays. The ticket sizes will increase when it moves into the buyouts phase, and that's when I think you'll start attracting more money from the Middle East. If you have managers who start splitting amongst themselves, then this trend will not change. I think investors from outside are looking for people who are building larger platforms where they go from 15 team members to 150 team members. And these 150 team members include many who have operational expertise as well. And that's when you see a quantum jump in the confidence that LPs have in Indian private equity and the amount of capital that they're committing to Indian private equity. But if the situation continues as is, whereas every time a private equity team becomes 15 people, they split into two and want to set up two more funds. So somebody was sharing the statistics with me that in Bombay itself you have hundreds of funds. Now that's not very encouraging.
True.
Because when people start splitting up like this, you never see a large institutional platform, which is what the Blackstones or the iCapitals of the world have become to be. And that's where the true test lies for the Indian private equity industry. If they don't cross these hurdles, it will be very difficult. Having said that, I think purely by what is happening around in the market, I think there has to be a serious consolidation. I think some funds would realize that they will not be able to sustain the way they're going for fundraising now with new funds, with smaller teams. The returns in China are higher, but so is the risk. I must mention that it is very difficult to invest in China, and you really do need to have very strong partners on the ground to be able to do this in China. So on a standard risk-reward basis, it is more risky and more rewarding also to in China. The thing that really clearly stands out in China is you are able to get large ticket deals in China done. So that's an advantage of being in China. In India, as I shared with you, that's not the case. And also in terms of corporate governance, it could be my bias being an Indian, but I do feel that India is a shade better than China on corporate governance.